Hey everyone, this is Dave with another innovative investment idea for your consideration. Today, we'll be looking into the three broad categories of stocks out there on the market, which will hopefully enable us to make better purchasing choices in the future. But before we get started, don't forget to hit the subscribe button if you're new to my channel to get more stock market content just like this. So, let's dive right in, shall we? The three categories are dividend stocks, safe and blue chip, and last but not least, growth. Each category has its own pros and cons, and it's very difficult to single out any one particular stock from the market as either a winner or loser without first paying specific attention to where it can be categorized. Fund managers or ETFs that pull together large amounts of capital from investors tend to weight their respective portfolios according to these distinctions, while individual investors will often align their risk profile or preferences in accordance to these categories. Dividend stocks are those that provide the bearer an alternate revenue stream, otherwise known as passive income because they don't have to perform any work to generate that money, that gets paid directly to the nominated bank or trading account automatically. Here are some names that you might know as examples of stocks from this category: ExxonMobil, an oil and gas company; AT&T, Wells Fargo; AbbVie, which is a pharmaceutical company; J&J, McDonald's, and Discover Financial Services. Let's focus on Johnson & Johnson for a second. If you had held a single J&J stock for the entirety of 2019, you would have received 90 cents after the first quarter and 95 cents at the end of Q2, Q3, and Q4 for a grand total of $3.75 by the end of the year. The yearly grand total is referred to as the yield, and in J&J's case was approximately 3% of the stock's price for 2019. It didn't matter if the stock went up or down from week to week or month to month, so long as you didn't sell it, you were entitled to the whole amount. All of the stocks named here would give the holder some amount of money to be paid at fixed intervals throughout the year. In the US, the intervals are usually at the end of each quarter, but some other countries like Australia only deliver dividends at the end of each half, not quarter. It's a completely viable strategy to build up an entire portfolio of these kinds of stocks, because after you have accumulated enough of them, you could end up in a position where the forthcoming payments are enough to sustain all of your expenses and lifestyle. The next category of stocks are safe and blue chips, which are essentially stocks you can literally buy, forget, and if history is any indicator, can expect at least an average rate of return over that period. They're stable companies with steady growth, predictable revenue, and universal brand name recognition that basically everyone on planet Earth will have heard of. You can see here, some of the names I've included are Microsoft, Walmart, Berkshire Hathaway, Apple, MasterCard, and Google, otherwise known as Alphabet. Stocks from this category are fantastic for investors with a moderate to high risk aversity, since they will assuredly receive higher returns than a savings account at the bank, but are offered peace of mind that the chances the company goes bankrupt is slim to none. The final category is what is collectively known as growth stocks. These are companies that are generally 10 years or younger, perhaps have even IPO'd recently, have a near vertical trajectory due to the high rate of expansion year to year, and in a lot of cases are often disrupting their respective industries. They are accelerating and growing so rapidly, or are doing things we haven't seen before, that it makes it extremely difficult to value or assess them accurately, and their current company valuations don't make sense or are just downright absurd in a lot of cases, because no one really knows what their baseline is. And I do stress the word current here, because growth stocks are aiming for dominance in the future. With the safe and blue chips, it is much easier to assess correctly because we have access to long historical data or an understanding of what their baselines are. Having said all that, the obvious disclaimer about growth stocks that I think is important to note is that investors speculate on where the future baseline might be. But that also means there is a larger risk and greater volatility than the previous two categories of stocks, as the uncertainty could also spell disaster if at some point we realize collectively that the stock falls short of the projected baseline or their growth decelerates sooner than expected. Now, the companies I've highlighted here include Tesla, Shopify, DocuSign, Zoom, Beyond Meat, Etsy, and Square. As you can see, it's exceptionally difficult to pinpoint where on the map they will be in 2 or 5 years, let alone 10 years or 20 years. On Wall Street, just like anything in life, growth takes time. Rome wasn't built in a day, as the old adage goes. Another point about growth stocks is that investors don't just speculate based purely on revenue growth, but sometimes user-based growth. If you recall a few years back when Facebook acquired Instagram for $1 billion, it wasn't because Instagram was generating high revenues, but it was because Facebook saw the tremendous value in its social reach and seemingly ever-increasing user growth that they themselves speculated could be monetized. It goes without saying that growth investors tend to be more aggressive and have a lower profile of risk aversity, and thus demand a higher rate of return than dividend or blue chip investors. Taking a step back and considering the market holistically, some stocks don't fall into just one category and might fit into several, such as could be illustrated by a Venn diagram. As an example, Facebook sustained incredible revenue growth of roughly 30% between 2018 and 19, even though they are considered blue chip because of their already $600 billion market cap. Likewise, a company like McDonald's with a market cap of roughly $130 billion is still offering a 3% yield dividend. I couldn't think of a growth stock that also pays dividends, since those companies typically retain cash to reinvest internally and grow themselves, or the rare unicorn stock that sits in the sweet spot at the intersection of all three categories, but if you guys can think of an example, let me know down below. Finally, you hear the word diversification as a buzzword that gets thrown around a lot in investing circles, but what it really means is that you allocate capital across all three categories as a metaphorical safety net. So for example, 50% of your cash goes into buying blue chips, 30% into dividends, and the final 20% into growth stocks. This is a fairly conservative deployment of capital, but is an example of how a family with 2 young kids and a lot of expenses and bills to pay might approach stock market investing. They wouldn't want to put, say, 80% of their money directly into growth stocks, because if the picks don't work out, the entire welfare of the family will be at risk. A young single investor in their 20s with a stable job, on the other hand, might very well put 80% into growth stocks because they have the dream of financial independence, retire early, or FIRE, and want to get there as soon as possible. Dividend stocks tend to be a great choice for middle-of-the-road investors who simply want additional cash in the short and medium term for expenses or new investment ideas, and not just a pot of cash at the end of the rainbow. Diversification also encompasses allocating capital within the same category. So for example, as an investor with high risk aversity who wants to exclusively purchase growth stocks, I might put 50% into Tesla and 50% into Beyond Meat, just because then I'll have 2 horses in the race instead of 1. If Tesla fails spectacularly and goes bankrupt, I only lose half my investment, and I could even be carried if Beyond Meat stock goes up 5x or 10x. Ultimately, diversification is a numbers game. Don't put all your eggs in one basket. But that about wraps it up for this video. Don't forget to hit the like button if you found this video helpful or insightful, and drop any other questions, thoughts, or comments down below. As always, thanks for watching, and see you in the next one.